If you got a tax form from PayPal, Venmo, or Cash App this year, or you're scared one is coming, take a breath, because most of the panic online is wrong. That form is called a 1099K, and by the end of this video you'll know exactly when you owe tax on it, when you don't, and the one mistake that makes people overpay on money that was never taxable. Let's break it down. First, the single most important thing. A 1099K is not a tax bill. It's an information form, a report of how much money moved through an app to you during the year. The app sends a copy to you and a copy to the IRS. It doesn't decide what you owe. What you owe depends on why that money moved. So what exactly is it? A 1099K is sent by payment networks and card processors, PayPal, Venmo, Cash App, Stripe, eBay, Etsy, and similar platforms. It adds up the payments they processed for you and reports the gross total. Think of it as the app saying to the IRS, here's everything that flowed through us to this person. Now the part everyone got scared about. A couple of years ago, there was talk of a $600 threshold, that any $600 through an app would trigger a form. For 2026, that is not the rule. The one big beautiful bill rolled it back to the older, higher threshold. You only get a 1099K once you clear $20,000 and more than 200 transactions through that app. Here's the mistake that costs people the most, and it's the same rule we hammer on this channel. No form does not mean no tax. If you ran a real side hustle through Venmo and made $12,000, you won't hit the threshold, so no 1099K will arrive. But that income is still fully taxable. The form's changed. The rule that you owe tax on your income did not. And here's the flip side that trips up just as many people. Getting a 1099K does not automatically mean you owe tax either. Plenty of people get a form for money that was never taxable in the first place. So a 1099K is not proof you're in trouble. It's just a starting point you have to reconcile. Both fears are wrong, and the truth sits in one dividing line. Here is the line that decides everything. Was the money personal, or was it for goods and services? Personal money, paying back a friend, splitting rent, a birthday gift, is not taxable. Money for goods or services, selling something, freelancing, a side gig, generally is. Almost every 1099K question comes down to sorting your payments into those two buckets. Let's nail down the personal side, because this is the money you should never pay tax on. A roommate sending you their half of the rent. Friends paying you back for the group dinner or the concert tickets you fronted. Your share of a vacation. A cash gift from family. None of that is income. It's just your own money moving around, and it does not belong on your tax return. Now the taxable side. If people pay you for goods or services, you sell handmade items on Etsy, flip sneakers, do freelance design, tutor, or rent out your camera gear, that is business income, and it's taxable whether or not it ever lands on a 1099K. This is the bucket the IRS actually cares about, and it's where your deductions come in to lower the bill. Here's the trap that creates fake income out of thin air. When someone sends you money, the app asks, is this for goods and services or for friends and family? If a roommate marks their rent as goods and services by mistake, that personal payment lands on your 1099K as if it were business income. So you can get a form that overstates what you actually earned, and if you don't catch it, you'll overpay. What about selling your own used stuff? Here's the rule. If you sell a personal item for less than you paid, an old couch, a used phone, last year's furniture, that's a loss, and a loss on personal property is not taxable. But if you sell something for more than you paid, a collectible, a flipped item, something that went up in value, that gain is taxable. Most garage sale selling is at a loss, so it's usually not taxable, but it can still show up on the form. This is the real 1099K, straight from the IRS. The number everyone reacts to is box 1A, the gross amount of payments. Notice the word gross. That's every dollar before fees, before refunds, before sales tax. It is almost never the number you actually keep, and it's almost never the number you pay tax on. So always work down from gross to what you actually earned. Start with the box 1A total, then subtract the platform's fees, any refunds you gave, any sales tax you collected and passed on, and any personal payments that slipped onto the form. What's left is your real income, and then your business expenses come off that. The gross number on the form is the start of the math, not the answer. Where does it all go on your return? If it's a business or side hustle, it goes on Schedule C, where you list income and subtract expenses to land on your net profit. An occasional personal item sold at a gain is reported as a capital gain. And if the IRS gets a $1,099K for personal money you weren't supposed to be taxed on, there's a clean way to report it and back it right out, so it nets to zero. Let's make it real with two examples, because the same form means totally different things. Example 1, the side hustle. You freelance and resell through PayPal and bring in $18,000 this year. That's under the $20,000 threshold, so no $1,099K arrives. A lot of people would assume that means it's tax-free. It is not. This is fully taxable business income. So you report it on Schedule C. You had about $5,000 of real costs, platform fees, supplies, shipping, the items you bought to resell. $18,000 minus $5,000 leaves $13,000 of net profit. That $13,000 is taxed, both income tax and self-employment tax, whether a form ever came or not. The lesson: track it yourself, because the app won't. Example 2, the scary form that isn't. You get a $1,099K showing $24,000, and you panic. But when you go through it, $14,000 was your roommate's share of rent, $6,000 was friends paying you back for trips and group dinners, and $3,000 was selling old furniture for less than you paid. Only one thing was a real sale at a profit, a vintage watch you flipped for a $500 gain. So out of a $24,000 form, your actual taxable income is $500, the gain on that one watch. Everything else is personal money or items sold at a loss, which you report and back out to zero. If you had just trusted the form and paid tax on $24,000, you would have overpaid on more than $23,000 of money that was never taxable. That's the whole game. One important caveat before your system: this $20,000 threshold is the federal rule. Several states set their own, much lower thresholds, some as low as $600. So depending on where you live, you might get a $1,099K even when you're under the federal line. Don't be surprised by it, and don't assume a form means you did something wrong. Same rules apply. Sort personal from business. So here's the system that keeps you safe and stops you from overpaying. 1. Keep personal and business money in separate apps or accounts, so they never get tangled. 2. Always tag personal transfers as friends and family. 3. Keep records of what you sold and what it cost you. And 4. When a $1,099K arrives, reconcile it line by line before you ever put a number on your return. Quick recap. A $1,099K is a report, not a bill. For 2026, the federal threshold is $20,000 and 200 transactions, but your state may be lower. No form doesn't mean no tax, and a form doesn't mean you owe. The only question that matters is personal versus goods and services. Sort that, work down from gross, and you'll pay exactly what you owe and not a dollar more. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, don't fear the $1,099K, and don't ignore it either. Tag your personal payments correctly, keep clean records, and reconcile every form before you file. Do that, and you'll never overpay on a friend paying you back, and you'll never get blindsided on real income. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.